Okay, we are all set up. Wow, I made it just in time. Okay, let's get started. Good morning, everyone. It's good to see you both. All right, for everyone else, thank you so much once again to making it to the KoreSummit webinar series 2021. My name is Oscar Joffrey. We have a very interesting discussion this morning that hopefully will enlighten. I know I have a few questions today, more than I did before, which stir things up a bit. You know, the format for us is very interesting. It's more about kind of a fireside chat discussion with everyone, get everyone talking and discussing the topic at hand. And then, of course, this is being recorded so everybody can watch it later. So before we get started right into it, I want to give everybody an opportunity to meet panelists. Sherry, please.
Hi, I'm Sherry Noonan. I'm the CEO and co-founder of Rialto Markets. Rialto Markets is a FINRA registered broker-dealer and alternative trading system, or ATS, and we are focused on private markets across all private markets.
Thank you. Elliot.
Hey everyone, Elliot Chun here, Managing Director at Wield & Co. Wield & Co. is a US registered broker-dealer. My team, Emergence, focuses on the intersection of emerging technologies, private companies, and helping with the capital raising and strategic kind of M&A and advisory and capital structuring part of the process here. And for those that, a little bit of background on Wield & Co. Was founded by David Wield, who among a few different things, including ex-president of Prudential Securities, vice chair of NASDAQ. A lot of his writing became the foundation for the Jobs Act, which laid the groundwork for Regulation CF as well as Regulation A+.
Nice. Finally, it's a nice way to put in David Will, and I like that. Thank you. I appreciate that, because every time you're on, if you don't say it, you know I will. You know, I thank you guys for giving me some of those tidbit questions. I'm going to start it off with, I've had 3 calls today already this morning, and I have not been able to answer this. No matter how many times I hear this discussion, and I'm sure others that are listening in will. I know it's run over and over. So I'm going to give each of you an opportunity to please give it to us in the most layman's term possible. What is the difference between an exchange, and we're now using the word ATS, and secondary market, and are those things different? I'll start with you, Sherry, and then obviously, Elliot, I want to go to you as well.
Absolutely. So the difference between an exchange and an ATS is that an exchange is their own self-regulatory organization. So they create their own self-regulatory organization. There is oversight by the SEC. They have members and they have certain policies. So when an exchange, for example, wants to change their pricing or wants to add a new line of business, they actually go to the SEC and request rule changes to their member book and to their actual policies. But they really are their own sort of standalone regulatory organization. An alternative trading system, or an ATS, FINRA is the self-regulatory organization that oversees an ATS in conjunction with the SEC. The SEC does not approve ATSs, but ATSs file information with the SEC. The SEC is very, very involved with the operation of ATSs. And whenever there's a material change in operation with an ATS needs to go to FINRA, which is their self-regulatory organization, as well as the SEC, and file the appropriate paperwork, whether that be a MAC, which is a material change, and you know, discuss that with FINRA, as well as after FINRA is comfortable with the change, then they file paperwork with the SEC in a Form ATS, which basically explains the change that's happening to the business. But at like the highest level, that's the difference. And I'm happy to take you through the sort of history of ATSs and how they came about, but that's the big difference. And Elliot,
I don't think the history will be. You're right. We could be there and we will. Actually, that's a good one. I've never even brought it to that level. That's good distinction. Self-regulatory, ATS, FINRA, and SEC. So I'm going to put it to you this way, Elliot, from an investor or a company point of view, because that's who's asking the question. Because to them, I don't even know how to, could you provide an insight to that?
Well, yeah, so functionally, right, besides the great explanation that Sherry gave, functionally from a investor who owns a position in a company that is trading either on an exchange or an ATS, functionally it is relatively, there isn't much difference from a functional perspective, right? As long as the issuer has gone through the correct process and the ATS has gone through the correct process, as well as the exchange of listing that issuer on their trading platform, and this is part of the beauty of this, functionally, it is not much different. If you are owning a position, there isn't, you shouldn't think of it as different in how you are able to use the platform, which we'll talk about what you're going to use the platform for. But I like to think of it as, hey, pretty much it's relatively the same. Now, it's not under the covers, but from an investor, the broader users of this, very, very similar functionally.
Okay, so it's similar function. We use different terminology to describe it. We know it's self-regulatory and obviously regulated by the regulators themselves. Okay, we'll dive into a little bit more deeper in the conversation. So now, obviously, we're talking more about it in more detail today than we were years ago, but now it's quite front and center because of Regulation A. So Regulation A itself, the regulation has this ability to give that liquidity for the investor, and there has to be a venue for it. And that's what this venue is. So Sherry, if you, obviously this is a big day coming forward for all of us coming soon. So walk us through.
So walk us, what would you like me to walk you through, sort of?
Oh, sorry, my apologies. What I meant is, sorry, obviously, you know, with Regulation A, right? It's, for most people, there is the ATS, Regulation A, it's coming together. With the new amendment coming in future, well, what is the impact of all those three things that are going to happen for secondary markets?
Yeah, absolutely. And I mean, this has been really around for a while, but you know what we've been focused on from our ATS is really making the ATS, which is quite different from both exchanges as well as other ATSs, is making the ATS available both to the individual investor, so you don't have to go through another intermediary, another broker dealer, or another member, as exchanges would call them, members. And then it's also we've really worked to make the cost, the actual price point for the issuers one that works, because a lot of exchanges, the listing fees can be quite substantial. So that's really what we've worked to do with our ATS in terms of you know, what it allows issuers to do, and it is really provide their investors with an off-ramp, right? There's an on-ramp where you can buy the security, but there's no sort of off-ramp. So that's going to open up the group of investors to the issuers, because investors that otherwise wouldn't have tied their money up indefinitely now know that there's a monetization strategy, there's a monetization component that they can avail themselves of. In terms of the date that's coming up, you know, the increase in the caps, I think, are definitely going to, for specifically Reg CF, but even for Reg A, will drive more interest from private companies as a capital formation tool. It's a very effective tool to have in their toolkit. And Elliot, I don't know if there's anything else you want to add.
Yeah, and I like your description of off-ramp, because that's very accurate, and it's a visual one as well. It's also not the term that Oscar used, which was liquidity, and I think we have to be very, very careful anytime we're talking about this space to differentiate between the two, right? Having an off-ramp or an ability to sell your position as an investor is one of the biggest benefits to this financial innovation. Even though it's not necessarily innovation, it certainly is from where we're talking about in February of 2021, particularly for private investing. The ability to be able to sell your position or off-ramp your asset or your position did not really exist prior to the whole RegA Plus environment. Additionally, as a couple of points that Sherry had mentioned, the listing fees and the fees from an investor perspective were almost prohibitive when you take a look at the amount of capital that was being raised, as well as being able to actually provide that ability to off-ramp for an issuer's investors. It almost became, it was from a pricing and cost perspective, prohibitive. It was very difficult to actually make happen. And so with these innovations that we're seeing today, we're actually looking at, for almost the first time, a secondary market scenario that makes sense for both the issuer as well as the investor. And I think that's an important part to highlight during this discussion, is that it needs to work for both parties. And it didn't previously, and we're now moving to an area where it does make sense. And so you're seeing the investor get the benefits that we have been promised for a few years now. And the promise was there, but I would say that the technology to be able to help facilitate that in conjunction with the regulation environment just wasn't there. And the great thing is that we're starting to see both change and both kind of merge into an area where it is there now.
And that's obviously going to be impactful for companies. I haven't heard on-ramp, off-ramp, and I'm trying to put it in, I just want to make sure I'm clear. So when you use off-ramp, I use the word liquidity, and sometimes when I catch myself, I should be saying a venue, a venue for potential liquidity. That's really what I'm correct in that, correct?
That's correct. I mean, really, the big misnomer, I think that's been thrown around previously is, and it can be difficult because you can say liquidity and mean different things, but what we don't want there to be a misconception about is just because there is an issuer that is on the Rialto platform, that does not mean that it's going to be an actively traded issue. Because these just are not supposed to be, they're not meant to be actively traded issues. They're private market securities with market caps of 10 million to $100 million. The beauty is that we are providing issuers and investors with the capability to now invest in these types of securities and monetize their investment. That does not mean that it's going to be trading like IBM, because it's not IBM. It's not in an index. It's not, so we just need to be very careful about what we've done. What we've done is reduce the friction associated with issuers being able to provide this capability to their investors, and investors to be able to actually monetize their investment.
And we take it a step further, Oscar. I basically have struck the word from my vocabulary. I think my compliance team.
Which word?
Liquidity. Okay. When talking about private markets, because as Sherry had mentioned, it's a misnomer, right? And the word means it feels there's a lot of volume. It's easy to get in and out, active trading market, but that's well said. It's not what this was intended to be. It's not intended to be a liquid market. It's intended to be the function of allowing for an investor to sell their position or off ramp. And it's a different distinction, but it's important. And as you think about more and more of the regulatory landscape, we have to be, the industry needs to make sure that they're not misconstruing what this function is supposed to be for. And it's not supposed to be liquid. It's just supposed to provide an opportunity to sell your position if you would like, which is a massive benefit for private investors. When you think about the typical private investing landscape, you're usually locked up for likely 10 years in your investment, just on average, right? You would say it's a 10-year lockup in a private investment. Sometimes it's less than that, sometimes it's more. That is very challenging because if an investor has something happen in that 10-year time period, they don't have access to that capital. And a lot of things can happen in 10 years. So it was prohibitive because only typically the larger and professional investing organizations into private companies had the wherewithal to be able to say, yeah, I'm confident enough to lock in this amount of capital for this amount of time. And so for individuals, accredited investors who are individuals, it was much more difficult to be able to commit, even though the returns could be substantial in private markets. It was very difficult to commit to that amount of time in an inflexible structure in order to get access to one's capital. And this is where the secondary market ATS innovation is a game changer.
So here's a question I have for you. So after my last webinar we had about secondary market, I decided to go and to a number of those who are providing the service. So I have it maybe in two parts. I found the word liquidity, the constant terminology being used, and I hear what you're saying. I do, I understand it. And I also see how they're selling it, and I understand the confusion. Look, we haven't even got to the next part, which is separating the different types of ATSs. So it's like, you know, I know the industry uses words like on-ramp, off-ramp, but the investor themselves, they don't understand that language. It's that lingo that we use, like KYC, KYB, like we use internal. So is the industry, I get it why they're using it. And I'm always careful to say that it's a venue meaning that you can place a bid for your securities. It's going to take time for that to develop. But let's hypothetically say it does develop. And not to say that it's not an IBM, but there's a bit of a spark plug. I mean, there is one particular secondary market already that's indicating the level of interest that happened in one day was in the billions. And so I respect the fact that we're not going to use it, but is it a regulatory issue, or is it just the
yeah,
sorry.
I'm really happy to talk about this. It's an economic issue. We could have market makers, not market makers, but liquidity providers, because we are an ATS, not an exchange. So excuse my terminology. But we could have liquidity providers that stand there and provide a two-sided quote. The question is, what's the cost? Nothing's free. What's the cost associated with that? And is it economically feasible for an issuer that has 10 million outstanding, 50 million outstanding to pay in whatever way that those economics transfer, because there are lots of rules and lots of regulations around this, but does it make economic sense? And is it practical? And is it needed? Or so, you know, we think about liquidity provisioning all the time. We're constantly thinking about what do we need to build to make investors and make investors comfortable in terms of their investment and the price discovery around their investment. So things like research, we talk about research all the time. Things like other quantitative information to provide investors to give them to give them the comfort that they understand the price discovery around their holdings, so that they can make an educated decision when they're looking to liquidate. What is important to realize is, you know, over the next year to really 18 months, I believe that there will be a lot of liquidity provisioning protocols that will come out to the market. And it will be everything from, you know, call auctions that like we have to real-time systems, which we're working on something like that right now, to liquidity providers standing there on both sides of the quote, which is possible. It's important for everyone to realize that's not a free service. That costs something. And so someone's going to pay in the ecosystem. It might be the issuer, it might be the investor, but someone will pay for that service. So, it's important to realize that we're building this market and this ecosystem. And so, to not lose sight of the fact of the economics behind all of this.
And to add to that, when you look at the current infrastructure for publicly traded equities, you're looking at 130 years of financial innovation to get to where we are in 2021.
We could do it in 12 months.
So we have to be realistic because there's going to be a lot of services that are required. Research certainly one, market making / liquidity providers certainly another, other ancillary services that can help the investor navigate the process. So certainly education is a big piece. I love hearing about potential protocols that can come in and really help with this. That is very much a 2021 tool that is being used to solve a 2021 problem. Love hearing that. And what I mean by that is that that tool doesn't necessarily exist in our world today. A liquidity provision protocol is something that is very, very new. The advantage is that we have tools now, blockchain being one of them, that can allow for these innovations to really develop properly and then be implemented in an institutional way while still addressing a generally retail market. But agree 100% with Sherry in that there needs to be other ancillary services to support the aftermarket issuance of these private investments. And we're not there yet. That's one of those things where we're just not there yet today. And we have to figure out the economic piece, again, to Sherry's point, because it needs to make sense. And I think a lot of misnomer in the way public equities operates today. You see oh my God, a Robinhood, they're not charging any commissions. Oh, but by the way, it's pay for order flow, which people own. Oh, so they're not giving it away for free? No, they're not giving it away for free. They're getting compensated a significant amount of money. That's why their valuation is so high. So the private markets, RegA plus secondary market trading function does need to figure out its economic models, incentive models, to make sure that everyone's properly aligned in the process to facilitate a well-functioning buying and selling. Because I think buying part, we've been talking about the selling of position. I think the buying is going to be as interesting going forward as more and more people are comfortable with what this market looks like. We're going to have a fantastic number of people that are didn't get in the primary issuance, but maybe they're users of the product or consumers of the service. And now they're saying, well, I can't, your option previously was, hey, you don't have any chance at buying into that position. You have to wait till the IPO, which is the exit strategy of the 50 other institutions and stages before. Now you're going to have an opportunity as an individual to potentially buy into some of these in a secondary market. That's fantastic. That part is fantastic, but we need a little bit more infrastructure around it. We need a little more innovation to help us get there.
That's an interesting point. I wonder if the same dynamic that changed in the way primary capital is raised, meaning if I describe it, was I would go to my broker dealer, they would be the front person to selling. They would make a judgment call on me rather than me giving me an opportunity to present myself in front of the investor. the reason I followed this path 11 years ago was I don't want that middleman to tell me anymore whether my deal is good anymore. As Andrew Cohn often says, I'd rather have 3,000 people that tell me they love it. So I'm going to take that model and bring it to secondary. Because one thing about secondary market, you touched on it a bit, Sherry, was that you made a distinction, the type of secondary market you're bringing to the market, but I think I want to touch it on the two different types. And the reason I'm going to touch on that is because, look, I'm going to call it the way it is. The professionals don't get it right. That's the bottom line. And I'm not an advocate. I do believe they should be there, but people are smart enough. They're making their decisions on their own. The momentum is going forward. There's still a broker dealer involved. You're facilitating, but the individual made that buying decision on their own. The same way they're going to make the selling. But I'm that distinction, I think it's going to matter because right now they make that purchase, and depending on the type of ATS you go to, that power gets taken away from you because now other issues get in the way. People's, I don't like the sector. I don't think it's worth that much. Do you understand the question I'm asking? Because
Yeah, so there are regulations from a broker-dealer perspective. So how we approach this is we're really building the infrastructure. We're building the rails, but we are not in the advising business. We're not in the advisory business. We're not an investment bank. We're not a registered investment advisor. So really, we have obligations as a broker-dealer to perform suitability. But that's really under Reg BI, and you need to have suitability to make sure that you understand that the investors understand that they can lose their money and that everyone's on the same page around this particular investment or investment set. But then after that point, we allow the investor to invest as they would like. Now, we won't allow them to invest 10 times their net worth, but we will allow them to make an investment. And that's where I really think the future, to your point, is going, where people are really going to take control of their financial futures, and they're going to want direct access to investments that they previously have not had the ability to directly access. So the way that we work is we interact directly with the investor and allow them to select those investments and participate in those investments. Whereas, there may be the other model I think you were alluding to, which is if you want an investment, you need to call your broker dealer, who will then invest in that security on your behalf.
Well, no, not necessarily that way, because I'm not picking on you, Elliot, but thank you for bringing it up, because look, one thing that I've understood, I'm not here to remove the layer of compliance and all that. And I think from the outside, it can provide great guidance, but not everybody's like you, Elliot. Well, you'll have an open mind. I have met broker dealers that have a bias towards certain things, like minorities, somebody of color, because it's a female CEO. My God, they don't have a clue. That bias, to me, whatever layer comes in, or you're too small, you only make $1 million, or you're this or that, you come from the West, you're a Californian, whatever those biases are, they're removed here. But nevertheless, it's still a regulated. So that's why I think it's going to change. We don't have the data yet, agreed, but we do see the momentum. So the momentum is, so the statistic is right now, guys, here's what we do know now. So in the total lifespan of Regulation CF, there have been over 1 million non-accredited investors participated in investing. And RegA, very soon we're going to have that information as well. And I would say that number is at least 3 times or 4 times greater, which is good, which means these people made their decisions without the biased opinion, just based on their own, which should trickle to the other side element, which is very interesting. But fundamentally, I do want to speak of that just for clarity. There are 2 different types of ATSs, even though the other one can say we deal with the retail investor. The investor themselves, personally, Elliot Chun, cannot go to certain ATS is in place his own, he has to go through a BD, and that's one. But your platform, I'm going directly.
That's correct. It just and to be even more pedantic,
yes.
an ATS is also a broker dealer. So all ATSs are broker dealers. Not all broker dealers are ATSs. So when you go to an ATS, by definition, that is also a broker dealer, because our self-regulatory organization is FINRA, and so we are a broker dealer. However, there are ATSs that within the confines of their own network, they restrict the ability for retail users to interact. They require that all orders go through another broker dealer, a broker dealer to come into their network.
And
okay.
my comment is, we need, as the infrastructure is being built, we need optionality, right? Because
yes,
we need there's going to be some where maybe, I don't want to call them less sophisticated, but there's going to be issues or scenarios where someone comes in and wants somebody that is either completely hand-holding. I don't want to deal with any of I just want to tell somebody I want to buy that company because I use that product and I saw it online, or I got an email from that person. Like, you take care of it, right? There's going to be that option, and there's going to be the other option of, I'm going to go and do that myself. And there's probably going to be other use cases of interested investors that are going to want to engage in the environment. And maybe there's another method for them. Who knows? Innovation is moving quickly. So there's absolutely a space for both. We'll see which one the market ends up taking. I definitely am a believer of the more self-directed type of behavior. I think it's important, but the problem there's a big education curve, and then there's an awareness curve. Then there's the education, like, oh, what is RegA? What is Reg CF? So I think, generally speaking, most people know that. Education-wise, there's a big gap, right? But you had mentioned there is 1 million unaccredited investors, Oscar, but you love throwing out the number in the US. There's 230 million people out here.
Oh, I
that
know,
could
I
fit
know.
into that bucket. So we've got a long way to go.
We do, without it.
And then once you get that education, then it's the training side, and then you have the implementation. So we got a few other phases to get through, and the more options that that the industry is able to provide in a regulated and compliant way, I think is helpful for all of us. And as we start getting more and more metrics, and we start understanding the profile of the person that is engaging in these markets, then we can certainly help curate and customize specifically for those groups. So,
I think, Elliot, your exact point, if you think of like the innovator's dilemma, the curve of the really early adopters, that's the 1 million Reg CF investors, right? They're the folks who want to open up the box and put it together themselves. But most people, the mainstream, don't want to open up the box and put it together themselves. They're going to either want to go through their IRA account or their RIA or something else. So really having the flexibility to have individuals go direct, the folks who want to do it themselves, as well as plugging in networks, right, is going to be really key. And I think that's just going to be an evolution of this space. And there are going to be a lot of winners, a lot of different venues that are going to be developing in very different ways, much like the equities market structure developed in very different ways. There were different types of venues that popped up, and they serve different use cases.
Agreed. And we're already starting to kind of get that. This was, once again, it's good to point out, we're just scratching the surface. We're just getting started. And you know how I feel about education. I'm an advocate of it. I think the only way we will ever reach that goal over here is if we constantly educate. And we're going to need to repeat this over and over again. But I want to spend the next part of the discussion today is that it is here. So let's, hypothetically, we are at the education. training and implementation phase. We don't have the other parts, but it'll come. So now I'm company ABC. I'm ready to go. I get a RegA offering or I'm doing one. What do I need to do next now from a company? We've talked about the investor and all that, but before the investor can come, so the selling shareholder, sorry, the seller to Offramp, see, Offramp, they need to come to you. So can you walk us through that phase first?
Absolutely. So issuers come to us, and we work with a lot of people who help introduce issuers to us who are familiar with our product, and we will talk to them about what we offer in the different protocols that are available, whether they would like to, handle it just monthly or quarterly or daily. And in terms of monetization opportunities for their investors. And then from there, we have an application process. They work with our onboarding team, go through exactly what they would have gone through from KYC, AML. And, we work in two different capacities. We work on primary offerings as the broker of record, and also then on the secondary. So if an issuer uses as the primary broker of record, then that flows a little bit easier, but it's not necessary. We work with other broker dealers who will then take their issuers and bring them onto our platform. There are listing criteria, placement criteria, and then it takes about six weeks to actually get the issue on the platform. So if you're doing a raise, sometimes it makes sense to do it at the same time so that it's available once the raise is complete. We will halt securities during a raise so that so issuers aren't competing with themselves.
And it is one thing that, Ellie, you brought up a few times about secondary, and if you can elaborate on it, is that during the time that someone's doing a capital raise, sometimes we need to say no to certain investors, not because we don't want them, but this where it plays out for the secondary, right? It's also the next coupling to it. What role would your firm play in this onboarding ramp to the ATS? If you were the primary BD for the RegA offering that you're working?
Yeah, so a lot of the infrastructure that is being built now, there are options, and it's important to consider what those options are and what's best for you as an issuer and what's best for your future or current investors. And so understanding what those issues are important for that issuer, and then analyzing what products are in the market that can help fulfill those requirements is very important, because especially today, it's not like you are going to select multiple ATSs off the bat. It doesn't make sense financially for people to do that. Maybe if it doesn't make sense today. So it's important to be able to consider, hey, what's out there, right? And so, we have a very objective technology and service provider objective, meaning we don't have, we know groups in the space. We constantly are making recommendations based upon that group, but that recommendation is based on what's best from what we consider for that particular issuer. And it's important to be able to have that objectivity because, look, the environment is changing quickly, and the functionality is changing quickly as well. I would never expect an issuer to say, oh, this group is doing that, that one's doing that, this is on their roadmap, and we want that functionality, so I'm going to choose that one. That's just unrealistic. There's already so much an issuer has to deal with. So that I think is the important part. We would play in the process in that kind of objective evaluation of what they need, and then which groups out there can help fulfill those needs.
And okay, so we've selected the ATS. I think you went through the on-ramping, but the company's not done yet. I mean, one thing is saying I want my securities to be placed, not listed, placed on a secondary ATS. The company's not done. There's still some other regulatory items. We have blue sky to deal with because these are private exemptions. And then we also have securities manual. I know you're laughing because this is this, you know, it's amazing how many times I keep hearing, oh, it's so easy, just come to us, we can list you. And nobody, I even asked, so what about blue sky? Oh, no, you don't need to worry about anything. There's no blue sky here. Sherry, please.
So I'm laughing because, you know, I was just looking at the Office of the Small Business Capitalization, a presentation that they made to, this is of the SEC. This is a committee within the SEC. And one of their slides said, our rules are too complex, period. And they have this great graph that shows all the different private securities and all the different exemptions and you know, how you need to comply. And it is just terrifying. I'm looking at it right now. It's a terrifying slide. But that's, you know, part of the issue around the private markets and why there's no infrastructure that's been built is because it's very, very complicated. And one of our jobs as an ATS is to make sure that as issuers come to us, they're aware that they have, you know, that there are obligations and we can assist them with those obligations. But there are, you know, blue sky requirements and there are registrations that come along with that. And so we will work with issuers and it will not allow issuers to come onto the platform unless they have completed these things. Now, we can either, we work with a law firm to do that, but we cover all of that. We cover all of those responsibilities. And I think it's incumbent upon an issuer to just make sure that those are being covered and that the platform they're working with isn't pushing that responsibility off to them without educating them, because you know it's complicated, and if you're an issuer and this isn't your business, you wouldn't know that you had this requirement.
And which issuers is this their business, right? I mean, very, very, very few, which is the absolutely intimidating and, quite frankly, when you think about things that can keep you up at night, this should be one. But if you've partnered with the right groups, it shouldn't be one. But look, for anyone that's going through this process as an issuer, you are putting yourselves on the line when you are raising capital in a RegA Plus. I mean, literally you're putting yourself on the line, because if something goes wrong, which we all know things constantly do, you are the one that has to answer to a group like the SEC. And nobody wants to do that without the right team around them to say, this is what happened. This is how we got into this, and this is what we plan to fix. You're rolling on that on your own, and you are not involved in the securities world. It's terrifying, and it should be. It should be terrifying because
I'm going to I'll terrify you some more. I want to terrify you some more. You ready? It's even lawyers who are giving the advice.
Well, that's
as Sherry and I discovered. There's only a few lawyers that really know this. And Elliot, I feel I concur with you, but I actually just had a challenging conversation with a party telling me that their lawyer, I said, listen, I'll get the lawyer. And the lawyer's adamant that they do not need to do this. And I said, okay, your call. I'm happy to make an introduction to Sarah Hanks. And so you could hear it. Forget me, I'm not a lawyer. I do see it already out there. It's already happening. I didn't realize how much it was happening, because some lawyers are telling clients, oh, hey, listen, you know what, just build an intranet, build a Craigslist here, and you know, you don't need to worry about anything else.
So we have a number of issuers that have come to us and have not completed the requisite paperwork that's required, and they came from other platforms, and so it was quite shocking for us to see that, because we understand the process in one way, so we'll go back and get them up to the required paperwork, but it's just absolutely critical, because at the end of the day, it comes back to the issuer. To Elliot's point, it's the issuer's responsibility. And I know people are going to be frustrated because they're going to say, but I paid this platform, I paid this lawyer, I paid this person. We're so early in the game that I think it's just a combination of people not really understanding the details and perhaps not giving the best advice. But that's really not a big consolation when you get a call from the SEC.
No, and it should be a surprise because we're already seeing some of the issues on the primary. But you're right. I mean, look, coming back to what you said before, Elliot, education. So now we know we even need to educate the industry itself before it can start putting it out there. So it is important, the clarity and the layman component to it, adding the layman to the regulatory side of it, which is, to recap your words, ATS secondary market, you still need to adhere to Blue Sky, which is what that means is you have to file in 50 different states, and then you need to file in what is called the securities manual. And that's not just a book, okay? But no, I'm serious. I actually
just one final point for me on that is we're talking about new things that we're talking about a date in less than 3 weeks that is big for the industry, right? And when you have these kind of new innovations, you're going to have groups that are making not the best choices. And we've seen it in a couple of other iterations, particularly in digital assets and crypto asset markets, where groups that it may have seemed like a good idea at the time, and they may have skipped a couple of steps, but you look back and you're like, oh man, you're basically banned from the industry because of the activities that you did. And so it's not, I'm not saying it's the industry's fault, because you're always going to have groups that are seeking to say, here's a new innovation, we can bring people in, let's do it. And I'm not saying that they're doing it in a nefarious way, but I am saying that there are going to be mistakes making. And as this market grows, the regulators, because it's their responsibility, are going to want to go back in time and go find people that didn't do it the right way, make them the quote unquote poster people. And that can be something that happens 2, 3, 5 years down the line if you haven't done it the right way up front, which is, it's tough, it's frustrating, but that's just the nature of securities regulation. And so, while we're talking about this particular topic, it's just important to, if you have to slow it down, or if you have to say, hey, we need to assess other groups, it's worth doing it, because again, we'll reiterate it, for any issuer, you're on the line, right? It is you that is on the line. It's your responsibility. And it's not an excuse to say, I trusted that group, or I didn't know, this is not my business. So it's just a word of caution as we go through this new role.
No, agreed. I think it needs to, obviously we don't want to make webinars this warning statement, but I think for ATS, we have to do it. We did it when primary capital raising, and we still have to do it over again and again to remind people what you can and cannot do. But for ATSs, Elliot, I concur with you. Right now, for all of those that are listening in or may watch it later, make no mistake, the SEC is paying attention. SEC is not like other regulators, to your point. They love to wait for you to keep doing it and for you to profit from it, because all you're really doing is making their case. And other regulators, they'll stop you right at the beginning, say, don't do that. But this one will wait. And if you're not talking to the right people, it can be very harmful for everyone involved, including the people who invested in your company, who really, their interest was really to make it a go. So obviously, let's touch into the March the 15th. It's going to change all of this. What do you see for yourself, Sherry? I mean, you're both a broker dealer, of course, for RegAs, and you're a registered ATS for allowing the everyday investors to come in. How's that going to impact you coming the 15th and then going forward?
Yeah, absolutely. So the 15th and going forward, we're seeing a lot more demand of people coming in and looking to avail themselves of those increased caps. And we're also seeing interest. I mean, even though we do allow the everyday investor to come in, we're seeing interest from broker-dealers and others who want to come in and participate in the ATS, which is great because it just provides a larger diversity of participants in the network.
And the larger diversity is vital. The industry needs more great use cases and stories to be able to point to show what we in the industry know is a fantastic innovation here that we have. And the increase in caps is going to lead to in my opinion, in the next 5 to 10 years, a wall of new innovators and entrepreneurs that now have an ability to access capital when they did not have that before, in a way that is beneficial to an investor. So it benefits the issuers and it also benefits the investors. And there aren't that many financial innovations that can do both. And so the biggest challenge with 1 million in reg crowdfunding was that you can't do much with 1 million. With 5, you can launch almost any business if you can properly access 5 million in early stage capital. And then when you move to Reg A plus, it's a natural evolution because you've now graduated and now you can access 75. The 50 to 75 isn't as important, but what is interesting is that you have an ability to raise after a period of time, 1 year, right? So if we think about where IPOs are, that being kind of the exit strategy for many of the private investors that got in early, and that currently being institutional funds and family offices that have access to this stuff. This is allowing broader access to more and more people. And you're doing it in a way where now they don't have to be locked up. And so with this March 15th announcement, we're going to see, as Sherry had mentioned, a diversity of issuers. We're going to see a lot of better issuers come into the space. We're going to see them naturally graduate to the Reg A plus environment. And that's going to attract, again, what Sherry had said, the economic part of this business, which is going to support this capital formation and capital movement throughout the system. And so this is probably one of the bigger announcements that the industry has had. Maybe an adjustment to the accredited investor could be more impactful, but besides that, this is as big as it gets. And we think that, this next run that we're going to see here is going to be very substantial for the markets.
No, I agree. And just to be clear, the announcement has already been made. It goes live on the 15th. Sorry, I just want to make sure that everybody knows we go live with it. And I know you touched on the accredited, boy, that's a discussion in itself, because accrediteds now are being allowed to participate with. So they're going to love this. No more going through accreditation, and they can invest with, unlimited limits. So, which is pretty exciting. We do see institutional money coming in. We've now had our first Reg A deal where institutional money came in. So I think there's all these little new things, but like anything else, it's an ecosystem. You had a starting point, a regulation that allowed, as you said, broader access, no lockup, but now you got to put all the pieces in place and infrastructure to be able to facilitate that regulation. And that's the part that I don't think people truly get sometimes. It's easy to put it out there and say, oh, yeah. But then you got to make it work. You got to put it all together so it can be, because one thing is saying, I want to trade something for $500,000. Well, how about trading something for $100?
That's it.
Right? It's the big one. I am personally looking forward to it going live on the 15th of March. I do agree with both of you. It's a new type of company coming in, new type of investors that will see and harmonize to the broader audience. This is not going to change the whole philosophy behind the Jobs Act of how people make the emotional connection to companies. You can still do it with the institution, but obviously they'll have a different view on it, but it doesn't change the fact that it is getting broader. And I am looking forward to the next discussion on this subject matter, where I think we'll need to recap again the education. What is the differences? How people get onboarded and how it works. But we'll be able to provide, to Elliot's point, some reporting element of where the buying and the selling is coming from. Will it be the same as it's happening in primary? Now, I'm going to make a bet. I'm going to make a prediction here. I'm going to stick my neck out. I have no experience in secondary market whatsoever, but I'm going to say the same audience that's participating here is going to be the same audience looking for it again. So, and the reason I say that is because I have an issuer right now that was given the advice by counsel that they could build an intranet without the filings and all that, and they're putting into it. They do once a month, they allow current holders to sell it to other holders, and it's constant. And so what that means is that the value proposition is still emotional within that same group. So it'll be very exciting. And for me, hopefully it doesn't become too technical in nature, but it will be at the beginning just to get some flushed out. So last minute comments, Sherry, from you. What, we're at the starting point. Well, we're getting close to the starting point, right? The launch pad.
That's, I mean, really 2020 for us was all of the infrastructure, if you will. It was getting the regulatory approvals. It was building out the technology. It was connecting into all the different required interfaces. 2021 is really go time. It's all of the issuers. It's getting issuers on, and it's adding value-added services like price discovery mechanisms and other protocols. And then 22 and beyond, I'm really excited for. I think this is just the beginning.
Elliot, your closing one?
Yeah, this is it's a great innovation, but just like any innovation, we're going to have some bumps and we're going to have some adjustments and some improvements. I think it's important for those that are entering into space to realize that. And there's going to be some zeros out there, right? There's going to be some great success stories, but I think we also need to be conscious that there's going to be some not so great success stories as well. And it's important to be able to say it's part of the learning process, and the people that are driving innovation forward and from an infrastructure such as you and Sherry, we're doing it with the best intentions. And that as we continue, it's going to be an evolution. So we're continuing to evolve. There's going to be more and more opportunity to involve with it, but this is probably one of the best financial innovations that the industry has put together to date, and we're happy to be a part of it.
That's great. Well, here's the last word. We'll give it to David Wheel, because whenever I have coffee with him, he says that one thing that 2020 did for everyone, and with the amendment, is momentum. And the thing about momentum, it doesn't force it, but there is constant change. And to your point, bumps, change, blow-ups are going to happen, but the momentum has started. So with that in mind, thank you, everyone. Sherry, as always. Elliot, not a dull moment with you, my man. No, listen, I know, look, I sometimes I got in my head what I want to go with, but during the day I have meetings with people and they ask me questions, and I absorb things very quickly. And thanks to both of you, I learn a lot. I take a lot of notes. I'm one of those, I listen, I take notes, and then I repeat it. And one of the things that I'm trying to do is demystify what people think it is. And so I bring that to here because I find that that's the easiest way that I can give them, hey, you want to know what it is? Here it is, watch this. Listen to it and you will have a better understanding. So thank you both for that. For everyone else, have a great afternoon, great week. We'll see you in the afternoon. We have a great March lineup. I'm going to let everybody know right now, on March the 15th, that's right, March the 15th, 16th, 17th, 18th, and 19th, Monday to Friday, we will have a slew of 2 to 3 webinars a day, but it's starting with David Wield, Sarah Hanks, and Vincent Molinari, starting it off with Jobs Act, State of the Union, kind of chit chat, fireside chat. We're really excited about this. This is a great day for all of us. Elliot, Sherry, have a great day.